to Market Catalysts. I'm Julie Hyman. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, earnings season off to a strong start following positive results from the big banks. We'll have the bank earnings report card. Plus, how tariffs are reshaping supply chains and why 26% of business leaders say tariffs could actually help them this year. And Netflix set to kick off big tech earnings. We'll tell you what to expect from the streaming giant as it looks to finalize that acquisition of Warner Brothers Discovery. Let's take a look at the major averages right now. We're seeing a mixed picture. Although futures have been pointing to a higher open, now the Dow is lower by almost 100 points. The S&P 500 kind of treading water here, and the Nasdaq is doing the same, although it is slightly positive at the moment. Taking a look under the hood at the sectors within the S&P 500, we have industrials and financials holding up a little bit better. Materials and utilities not doing as well. What's interesting here is with materials falling the most, they're one of the best performing sectors thus far in this early 2026, along with industrials, as we've seen this big rotation away from tech and into some of those names, although that's kind of being shaken up a little bit in recent days. And if you look at the NASDAQ 100 today, you see, that's year to date. Let's look at today. We see a mixed picture as well. So not a lot of direction being felt today. Something that's just standing out to me, though, as I glance at this board, memory chip makers continuing to have a lot of momentum. Micron is up more than 6% today, and this is also a stock that has done well this year. So while we've seen some rotation, there are definitely still some stocks that have not been rotated out of, certainly, and Micron appears to be one of them. Just as a reminder, this company did pretty well last year, up 250% over the past 12 months. Let's get back, though, to financials, because earnings season, of course, kicking off with strong results from big banks. The six largest banks in the U.S. reporting one of their strongest years on record in 2025, with overall revenue up 6% from 2024. Joining me now with more on what we learned this week, our banking reporter David Hollerith and Ken Leon, CFRA Research Director of Equity Research. And we should, of course, mention the big caveat is, even though the numbers were good, in a lot of cases, the stock reaction wasn't always good in every case. So that's an important distinction. But Dave, as you've been covering the earnings this week, you've kind of come to several different takeaways. So let's run through what your takeaways were. Right. So I think one is just, you heard it on the, we were talking about it on the show for weeks. It's just that all six of the big Wall Street banks have seen strong stock rallies. And so there's a lot of expectation for good and a little bit more room for disappointment given that they're historically at high valuations. So that was sort of the backdrop going into this. Then actual earnings results for the fourth quarter were a little bit noisy on a couple fronts. Citigroup had a one-time charge, so did JP Morgan. And then we had
Goldman Sachs with the Apple Card
exactly,
situation.
Yeah. And so expectations were a little bit mixed as a result. There's also some less appealing deal-making results. But because of all of that, analyst expectations in a way were not really, not necessarily grounded to what had been reported was going to happen. So there's some confusion each day of earnings in terms of the stock reactions immediately afterwards. But if you look at the full year outlook in terms of what the big banks have achieved in 2025, it looks pretty good. But then on the other side of that, a lot of the conversations during the earnings calls between for media and analysts had a lot to do with these things that are totally new and kind of clouding the outlooks for these banks in 2026, like the credit card cap demand from President Trump that came over the weekend. Mm-hmm. And then on top of that, I think in general, just the idea that the policy outlook is a little bit less clear.
Yes, right. And all of the noise around the Federal Reserve and Chair Powell as well. Ken, let's bring you into this. You heard Dave kind of sum things up here that things look pretty good at the banks, but they're also, they've also had a pretty good run. So how are you thinking about it?
Yeah, well, it's great to be here. And for 2026, we're looking for an outstanding year. Going into the fourth quarter, it's essentially trying to position yourselves that you can underpromise and overdeliver for 2026. the 25 results in itself, unless there was something significant, is really not going to change the trend as it relates to performance, revenues, and earnings. The controllables seem very good for the banks. And as David mentions, the uncontrollables or risk are noisy, but not necessarily changing the fundamentals for 26. So what we see is obviously the capital markets, both trading and investment banking, look to be very strong. The book is opening for equity underwriting. That was a disappointment on year-over-year comparisons in the fourth quarter, but I think it's the calendar just rolling into Q1, and that's actually good for the banks and bank stocks. Second, when we look at elevated equity markets, not just the US, but the world, that really bodes well for fee income on asset management, institutional, and wealth management. And then there's the transaction services that they have. Of course, the Morgan Stanleys and Goldmans shine better than JP Morgan or Bank of America, but we have an overweighting for the whole sector. It's 14% of the market. These 6 large banks are more than half of the top 10 top 10 constituents of the sector. It's about 60% of the sector. So you got to make a call on the global banks. We do, and we are positive.
Ken, when you look at all of the, the controllables versus the uncontrollables, leaving aside DC and policy for a moment, there are still a lot of uncontrollables. IPOs could still be weaker this year than some of these high expectations are baking in. We don't 100% know where rates are going, for example. We don't know where the economy is going and what the lending environment is going to be. So of kind of those things that are less known, which, are you sort of rating them on high risk, low risk, those various variables?
So baseline for the traditional commercial banking, we actually saw a pickup in commercial loans. So I think loan growth is expected to be maybe mid-single digit. That's healthy with the economy growing 2 to 3%. To your question about IPOs, so I cover the top 8 private equity firms. They're sitting on $2 trillion of companies owned that have to be monetized over the next few years. That process began really summer of last year. It's going to pick up this year. The reason for this is you can only do so many different levels of financing on the private side to grow businesses, and they're realizing that there's a bigger opportunity with the public equity market today. That was not the story of the last 3 years, and retail, not only institution, is now becoming an increasing big part of the equity market. That's all good for equity underwriting, and it's a global phenomenon. Actually, Hong Kong was one of the largest IPO markets coming off China new companies, and of course the US is going to do great. So I think there's a lot there really as a delta to surprise on the upside. Q4 was a disappointment, but it's to my point of a timing difference on the book and the calendar.
And Dave, it's funny the other item you referred to, the sort of headline risk from DC about the credit card talk. These companies kind of push back against it on their calls, and it doesn't seem like that is going to happen. But maybe it distracted from, Ken was just talking about private equity. Were there a lot of private credit questions on the calls, or did they sort of avoid those because everybody was talking about credit cards?
Yeah, that's actually true. I know there were a couple that came up, but none of it really materially changed things. One thing I will point out is that the lending revenues at these banks are really picking up in relationship to their markets divisions, their trading divisions. So the amount of lending they're seeing the most pickup in is to these non-bank financial companies like the private credit firms. And JP Morgan actually broke out how much they lend to private credit funds. So that's becoming an increasingly important part of their revenue stream. And then it's also kind of a place to watch for risk in terms of what that means to their exposure to private credit.
Yeah, Ken, what do investors need to watch there to see if there are any warning signs, if not industry-wide, even on a bank-by-bank basis?
Yeah, we don't see anything systemic. We're watching, again, the largest players. It's likely it's going to be idiosyncratic to some one-offs related to some problem small loans. But the private equity firms with their private credit businesses do a heck of a lot more due diligence than the large banks. So I'm fine there. On Washington, noise, but the subtleties with the Fed, of course, we've all seen with rate cuts, Chairman Powell, whether Trump gets 1 or 2 appointments. But on the supervisory side is a positive story, potentially easing the regulatory framework, whether it relates to the new stress tests for 2026 or the ability where banks can do a capital release, not have to increase reserves because of high distress scenarios. Very different than Switzerland, what UBS is facing. But in the US, what that means for investors is, in addition to price appreciation for these stocks, opportunities for dividend increase and share repurchase.
Ken, when you get those little headlines, though, like the credit card situation or like the threats to the Fed, is that sort of a reminder to financial investors, maybe don't get too comfortable and optimistic about the outlook on deregulation?
The bear case, of course, is if you've been covering this industry, which I have, for over 15 years, and many analysts have, you're reminded of when you have distress periods. We don't think that's the situation today. We also track all banks on credit risk. It's fine. The bull case is risk to the upside to what I said at the beginning of this interview, which is where the banks have underpromised. I think they'll over-deliver. Q1 is usually one of the strongest quarters, particularly in the capital markets. So we'll just have to see how this plays out. But all this is really important because we have to, analysts, justify the higher valuation or multiples for these banks. And that can only be achieved if we see upward earnings revisions from the consensus. I think that's going to happen unless there's any change in the economy or any kind of black swan event. But that might be a buying opportunity if they sell off.
We shall see. Ken, thanks so much. Dave, thanks so much. Appreciate it. Coming up, another earnings season underway. What investors need to know in the weeks ahead. That's next on Market Catalysts. We are heading deeper into the 2026 earnings season, and investors are asking a familiar question. Where are the real opportunities when so much optimism, especially around AI and tech, already may look priced in? My next guest says one of Wall Street's core assumptions may be flawed, that cheap means value and expensive means growth. Joining me now, Rob Arnott, founder and chairman of the board at Research Affiliates. Thanks so much for being here.
Thank you for the invitation.
Tech, it's interesting because it's been lagging a little bit, right? Mm-hmm. And some of the valuations have come down to some extent. So I'm curious, as we get into earnings season, whether you think that the numbers are going to reconfirm some of the optimism or that it doesn't matter because of how they're priced.
Some of the numbers will confirm the optimism, but it doesn't matter because they're expensive. So I look at this market as one that people think that fiscal and monetary stimulus stimulates the economy. No, it doesn't. It doesn't stimulate the economy. It stimulates asset bubbles. And as long as we are content to recklessly overspend, it will fuel surges in profits, and it will fuel surges in valuation multiples. So I don't see anything that would cause that to come to a grinding halt, but I would rather use the strength of the market to fade my existing exposure gradually and to redeploy money into markets that are cheap. Non-US stock markets, even after a winning year last year, are still very cheap relative to the US, and value is very cheap relative to growth. So to the extent people want to take some of the chips off the table on the growth side and redeploy them into markets that are cheap, I think that will pay off handily in the coming years.
It's really interesting that you say that about stimulus because Cathie Wood of ARK Invest, well-known growth investor on the other side, she just came out with a letter to investors recently, and she said the economy is a coiled spring. That's what she called it. And she talked about some of the stimulus that should make its way, whether it's taxes or some of the other stimulus measures. What do you think of that view? I mean, that because we are going to see some benefits accrue, for example, from the tax
refunds are going to be huge. I actually suggested to the administration that they have an executive order and direct the IRS to issue 2 refund checks. one for what it would have been before the tax bill was passed, and the other for the difference from the tax bill.
That would be politically interesting.
It would be politically very interesting. But in point of fact, yeah, that's a one-off stimulus that's going to be huge. How does stimulus work? It puts money in people's pockets, particularly in the pockets of people with high propensity to consume. The middle class, the lower middle class, the working poor, they have high propensity to consume. They'll spend the money in the private sector, and that will bolster earnings. Bolstering earnings flows largely to management and shareholders. Management and shareholders have low propensity to consume. So they run out and put their money in VU or our new Rouse ETF, and in so doing, push up valuation multiples. And so you have a surge in earnings and a surge in valuation multiples strictly on the back of stimulus.
And what's wrong with that?
There's nothing wrong with that.
Okay.
It does increase wealth inequality and income inequality. And so it achieves the opposite of its intended effect, but it does bolster wealth. And that's not a bad thing. It lays a foundation for when this 38 trillion in debt causes the markets to lose confidence in U.S. debt service ability. At some point, this has to reverse. But I don't see that as being in any way imminent. I think we're setting the stage for another financial crisis sometime in the next 10 to 15 years, but I don't see it as imminent.
So let's go back then to the here and now. You mentioned that international stocks still look like a good deal to you right now and have some more upside. Where else do you think that investors are not focused enough right now? What are some overlooked things that you think they should be looking at?
Well, one of the things that's just fascinating is we have this strange binary duality where investing is looked at as growth versus value.
Right.
Value is cheap, growth is expensive. Pardon me, expensive doesn't mean growth, expensive means expensive. It's actually a two-dimensional thing. Cheap versus expensive, and growing versus not growing.
Right.
Most stocks that are growing fast are expensive, but not all of them. Most stocks that are cheap aren't growing very well, but not all of them. And we need to throw that stupid binary worldview out the window.
Well, so let's take a stock like NVIDIA, which is much more reasonably valued than it was, so on a relative valuation basis, and it's certainly growing.
Oh, yeah.
But like, what do we call that? Is that a growth stock?
Oh my goodness, yes. We created RAFI Growth back last July, and I wish the idea had occurred to me 20 years ago. It didn't, but instead of calling expensive growth, let's call growth. If you identify companies that are growing rapidly, that is to say 5-year growth in sales, 5-year growth in profits, 5-year growth in R&D spending is high, those are growth stocks. Take the top 25% of the market, call that your growth portfolio. How do you want to weight it? By market cap, where you put most of your money in the most expensive stocks? No, how about doing it weighting the stocks in the portfolio by the dollar magnitude of their growth? If you do that, the two biggest stocks in your growth portfolio will be Apple and NVIDIA, because their dollar magnitude of growth is stupendous. In fact, each of those stocks individually explains 10% of all sales and earnings growth over the last 5 years. The nation's sales and earnings growth, 10% comes from Apple, 10% comes from NVIDIA. So those are your two biggest holdings. There's two stocks in the Magnificent Seven that don't make the cut and aren't in our index.
No. Tesla? No. Tell me which ones.
It's Amazon and Microsoft.
Huh.
Their growth in the 2010s was stupendous. Their growth in the 2020s has been nice.
What's the cutoff between stupendous and nice?
Top 25%.
Okay.
So they're in the second 25%.
So it's on a relative basis.
Right.
Gotcha.
So their percentage growth rates are nice, they're faster than the economy, but they're not the blistering pace of the 2010s. Apple is impressive growth off of a huge base. NVIDIA is stupendous growth off of a low base. The dollar magnitude of their growth is very similar. One because it was huge and grew quite a bit, and one because it was tiny and grew phenomenally. But if you do that, if you create an index where you choose stocks by the percentage growth rate, weight them by the dollar magnitude of the growth, going back over the last 28 years, we find that that would have beat Russell 1000 growth by 4.7% per year compounded for 28 years. So this is one of the exciting new product ideas that we've launched that it's not yet investable.
Right.
But it makes up one leg of what we call a trifecta: best value strategy, best growth strategy, and best core strategy available.
We have to leave it there, Rob. Thank you so much for coming in. It's good to see you.
Good to see you.
We'll talk
Thank
more
you.
soon, I'm sure. Coming up, Carhartt's CEO discusses the company's partnership with Ford as it tries to draw more U.S. workers into the trades. That's next.
I think for us, the Carhartt partnership really captures the spirit of the company. You know, tools for technicians, training to get more technicians in our dealerships, Carhartt stuff for our employees.
Ford CEO Jim Farley has warned repeatedly of a blue-collar employment crisis as the company struggles to fill mechanic positions. Ford's partnership with workwear brand Carhartt and nonprofit Tool Bank USA is aiming to help bring more workers into the trades. As of November, there were just under 400,000 job openings in the manufacturing sector. Let's bring in Linda Hubbard, CEO of Carhartt, as well as Yahoo Finance executive editor Brian Sozzi. Linda, thank you so much for being here. So how exactly is this going to work? And you know, why are you guys convinced that giving away free gear generally is good for recruiting? But talk to me about how this is going to work.
Well, we're so excited about this partnership with Ford because I think our two companies joining forces really allows us to scale some of these initiatives that we individually have been talking about over the last several years. This idea that jobs in the skilled trades, technical workers, are really undervalued jobs in our country right now and difficult to access. And so as we spoke with Jim Farley and Ford, we attended the Accelerate conference that he hosted last fall. We really, realized that collectively we have the same goals and that together we can be even stronger. And as we last year, our own campaign at Carhartt was around Made Possible. And what we were trying to highlight was all of the opportunities, all of these amazing jobs that people are doing out there that are really unnoticed or maybe people take for granted, but are incredible careers and opportunities for young people to make a great living for themselves and their family. So this connection with Ford has really will help us to really identify some tactics to go along with that awareness.
Linda, it's Brian here. Good to see you. I think I just missed you at that Accelerate event. That was the last time I saw Jim. And when I talked to Jim, he struck me by a lot of numbers he put out about the shortages for essential workers. One of them was, he's like, Brian, I have 6,000 bays open right now. We need mechanics to work on our cars. The fact that we can't get people into these jobs, how has that impacted a business like Carhartt that sells gear for them?
Well, we want to continue to, part of our mission, of course, is to make great gear to serve and protect the people that are doing these really difficult jobs. But we also, part of our mission is to continue to help them in different ways. And some of that is to just show there's opportunity out there for new people interested in the trades. And yes, of course, we'd love when they join the trades for them to be wearing Carhartt. Our partnership with Ford specifically around their auto training program is we're going to outfit the graduates, their scholars, their Auto Force scholars in Carhartt gear when they graduate, so they feel a sense of pride and confidence as they begin their new careers. So yes, of course, there's an obvious connection between our brand and the Ford brand and these people doing the hardest jobs around the world in every corner of the world. But even more importantly, I think all of us at Carhartt and Ford feel ourselves kind of called to this higher purpose of improving the economy, improving the lives of young people that are looking to make a better living for themselves.
Linda, of course, in addition to outfitting people in the trades, you employ people who make stuff, right? Clothing, namely. And
Yes.
I'm curious if you're having trouble filling positions in North America for folks who are making the apparel in your factories.
Our factories are in some small towns, and so, because of that, we have some, good source of labor very close to where our sewing factories are. We also, of course, are making product globally all around the world. So I can't really speak to all of our suppliers and how they're finding people to build our product. But we feel great about the people that we do have here in the U.S. in our own sewing factories. Some of them have been with us a long time, and we continue to attract new, younger associates as well.
Linda, what's the secret behind the Carhartt brand crossing over to more mainstream? Why do you think that's happened?
First of all, we're thrilled to have everybody interested in the Carhartt brand, but we really, truly are a workwear brand. Everything that we make is work worthy and is really meant to be worn to protect people from the rigors of the job or help them do their job more effectively. I do think that people are intrigued by functional workwear, and it does add to the value of buying a piece of clothing if it's going to last a long time or serve you for multi-purposes. So I think people are attracted to the authenticity of our brand and what we stand for, and we certainly welcome anyone in that wants to celebrate hard work and be connected to Carhartt and the people that are doing those difficult jobs.
Linda, Carhartt is really, it's a unique company, family owned, in business 137 years, outfitted the Ford factory workers in the 1920s, but also unique in the sense you make product in the United States. Sure, you do business around the world, but you make product in the U.S. How can you do this profitably given the costs of labor and other components?
We have been a manufacturer, obviously, for a long time. The people that make our product are really in the U.S. and around the world. It really is a craft. There's a very long training curve to be able to, sew and to do this work. But we've been very careful to make sure that we continue to make our product and the prices that we charge for it accessible, because we know our worker is challenged with how much discretionary income they have. So we have continued to be, effectively manage our cost and be able to provide great value and durability to our consumers.
Linda, thanks so much. Thanks you as well, Brian. Appreciate it. Coming up, business leaders are optimistic about 2026, even when it comes to tariffs. Why some say it could even help their business, particularly on the small business side. That's next on Market Catalysts. A new survey shows business leaders have a strong sense of ongoing optimism about the year ahead, despite ongoing challenges. That's especially true when it comes to their own businesses. According to Chase's 2026 Business Leaders Outlook survey, 74% feel optimistic about the business, 73% feel optimistic about their industry. Joining me now is Ben Walter, Chase Business Banking CEO. Ben, where do you think this optimism comes from among these leaders?
I think they're looking at their own businesses. If you look at surveys and what they say about the economy, typically you see a split between how people think their own business is doing and how the economy is doing writ large. When the news cycle gets negative, that gap widens. But people watch. I watch the street. I watch what individual businesses are saying, and what they're saying is that revenue is more than keeping up with costs. Even as costs continue to rise, even as inflation continues to be an issue, revenue is keeping up, and they see strong demand. So they're optimistic about their own outlook, and they're willing to invest.
And what kinds of businesses are we talking about here? Is it the kind of everybody from large to small, and are there differences in how they're perceiving what's going on?
The differences are more by industry than they are by size. So we see pretty optimistic outlook all the way. We survey from the smallest businesses all the way up through the middle market. And we've seen optimism all the way through. So I would say it is not size specific. It is a bit industry specific. Although even then we see pretty widespread optimism. Even manufacturing has been pretty optimistic. Retail, which has been a soft spot for the last few years, we still see optimistic numbers. There are definitely differences. Some sectors of transportation are still struggling. But that's, those up and downs happen all the time because the dynamics of any individual industry will vary. But broadly speaking, we see, 64% of the businesses we surveyed said not only do they feel good, they feel better about their business now than they have in the last 5 years. And that includes the big bump we got after tax reform. So that's a good place to be starting the year.
And it's also interesting to see it in the face of tariffs, right? Which, as we know, economists thought that it would have a terrible effect last year. It didn't quite, in part because they weren't enacted as initially we thought. But what surprised me is the number of folks you surveyed that said tariffs are actually good for their businesses. 26% said it would help them. Explain that one to me.
Well, it depends. Again, it depends what industry you're in. I mean, certainly anybody who makes a good feel, whether you agree or not, they feel like it hasn't been a level playing field for a few years, certainly with some of the things that go on abroad. So anybody who touches the manufacturing of a good feels like tariffs will be good because tariffs will enable them to get the price that they need to manufacture domestically. So that's a big chunk of the people who think that will be good. Broadly speaking, though, what we've seen, even with the tariffs that have been implemented, is businesses have been able to manage through that. And the bigger piece of cost pressure that businesses face now is not on the tariff side, it's on the employment side. We absolutely see wage pressure, particularly in skilled labor. And we have the numbers to prove it, but also when you anecdotally talk to small businesses, which we do all day long, they will tell you skilled labor is getting harder and harder to come by. Wage pressure is on the way up. They're trying to hire and they're struggling to hire, particularly for the skilled trades. So that's the biggest place that has them cutting back a little bit on their hiring plans, but not because they don't see demand. It's because the cost of labor is going up. So they're trying to squeeze that labor for productivity harder than they ever have before. And in fact, you saw that the Q4 print just came out for labor productivity. And we saw one of the highest prints we've seen, I think, in the last 6 years. So broadly speaking, they're just squeezing labor harder because labor's getting more expensive.
That is really interesting. And obviously, in the wake of the pandemic and all the labor disruptions we've seen, that's not necessarily the narrative you would have expected at this point in time. So Ben, finally, I got to ask you how they're using AI, because if we're talking about skilled labor, that's not necessarily something that can be substituted with AI.
I would think that, but even manufacturers are telling us they see huge opportunity for AI. Remember, anything that AI does that can improve the productivity of any industry improves the productivity of the workers in that industry. So we see. Last year, most of the AI adoption was focused in professional services. That's where we saw the highest interest. Not surprising. It's the place that you can think of the widest array of use cases the fastest. But increasingly, we see that flowing down to physical businesses, retail, manufacturing, other kinds of physical businesses, where they can use AI either to take inefficiencies out of the system in terms of process reengineering, or where they can use robotics and other things to help improve the labor efficiency that they've got in their system. So we see it being much more widespread than it ever has been. We see that adoption crossing the industry barriers into the physical world. And ultimately, if it can deliver the kind of productivity gains that we've seen in other sectors of the economy and are starting to see more generally, that's a good thing.
Very interesting stuff, Ben. Thank you so much. Appreciate it.
Thanks for having me, Julie.
Coming up, Netflix earnings are on deck. What to expect from the streaming giant. Stay tuned. You're watching Market Catalysts. Netflix is upping the ante. According to the Wall Street Journal, the streaming giant is pivoting to an all-cash offer for Warner Brothers Discovery Studios and streaming assets. It's another power play meant to clear the air as Paramount Skydance's hostile bid for WBD continues to cast a shadow over the deal. Joining me now with his take on the potential outcome of all of this is Rich Greenfield, partner and in media and technology analyst at Lightshed Partners. Obviously, this saga has been ongoing. Rich, thanks for being with us. So what do you think?
I'm getting tired of talking about it, Julie.
Join the club, So I'm just curious, what do you think the ultimate outcome is going to be? Who's going to win this thing, and what's going to be the final thing that sort of makes it end?
Well, look, I think the moving to an all-cash bid, which hasn't happened yet, but wouldn't surprise me. Netflix reports Tuesday after the close. It wouldn't be surprising that sort of ahead of or tied to earnings if they make this adjustment. They're not doing it. I don't really believe they're doing it because their stock is modestly below the collar, which would mean that the overall bid is 30, 40 cents light from what they said originally. I think this is about timing. Paramount has talked about the fact that they think they can get regulatory approval far faster than Netflix. Now, whether that's true or not, when you think about states and foreign markets, like there is still a lot that we don't know in terms of the regulatory review process. But in moving to all cash allows for a shareholder vote that could be in March versus a shareholder vote that would have probably have been in June. And so no one's going to have regulatory approval on this. It's not even possible to have March regulatory approval. So you sort of move that at least perceived by Paramount advantage, you take that off the table, and you basically put pressure on Paramount. If they're going to raise their bid, they've got to raise their bid sooner than later.
Okay, so if it does go to cash and it goes to a shareholder vote in March, Paramount has said they're going to take their bid to a shareholder vote also. If you were a shareholder, I mean, what's the most appealing outcome here?
I think the problem is right now with Paramount, again, assuming an all-cash bid, I think Paramount is in a tough place because with their bid where it is, the value of Discovery Global, I know Paramount has continued to say it's worthless. And remember, they need the split not to happen because if the split happens, all of the cash flow that they need to finance this transaction disappears too. So mission critical for Paramount is to stop the split of Warner Brothers and Discovery Global. Discovery Global is spinning off. The board looks at that as a critical transaction because they want to get these cable networks off their books. They want to start chopping them up, selling CNN to someone, selling Food Network and HGTV. Like they basically want to run an auction for the entire portfolio of assets. That's only possible if you get this split accomplished. And so I think unless Paramount meaningfully raises its bid, I don't think a couple of dollars does it, they have to meaningfully $4, $5, maybe even $6 raise the bid. And that's going to require a heck of a lot more cash that right now they don't appear to have, because I think if they had more cash, they would have already raised their bid.
So you came out with your predictions at the beginning of the year, and you said you thought the spin was going to happen. Netflix is ultimately going to win, but it won't close this year. They won't get regulatory approval. Has anything happened to change that view?
No, I mean, look, I think that is what we believe. And look, there's always the outside possibility. Larry Ellison is one of the world's richest people. Instead of putting $12 billion into this, could he put 40, 50, 60 billion of cash, dramatically delever Paramount, enable them to raise the bid, equitize the current bid? Sure, there is certainly that potential. There have been no signs throughout this entire process, if anything, going to get Middle East money, leveraging Paramount to 7 times at closing. There are certainly no signs yet that the Ellison family is willing to put far, far more capital in. And so that's why we still struggle to believe that Paramount wins. I know it feels like consensus on Wall Street that Paramount's going to come out with a knockout bid. It just hasn't happened, and it feels hard to see it happening right now.
Okay, Rich. Well, we're sick of talking about the ins and outs of the bid and what does each bid look like and are they going to raise it. There is something new this morning that maybe we're a little more excited to talk about, and that's Ted Sarandos's come to Jesus moment on theatrical release, apparently. He gave an interview to the New York Times, and in it he said, when this deal closes, we'll own a theatrical distribution engine that is phenomenal and produces billions of dollars of theatrical revenue. He says that he's committing to keeping the 45-day window between theatrical and streaming release. And he says, we want to win. I want to win box office. And he sort of insists in the interview that this is not a change of heart for him and for Netflix.
I mean, look, to be fair, Netflix was never going to do advertising until they did advertising. Right. So, there's certainly business models change over time. I think when Ted says he wants to win box office, I think he'd love to win weekend box office. Whether he is really in it to win global full year box office, I think is a very different question. And my guess is there's some very careful use of words when he's describing win the box office. Like if he's putting a movie in theaters, I'm sure he wants Narnia to do amazing on IMAX screens when it comes out this December. whether he wants to be the box office champ ever, I think is an entirely different story. But look, I think the reality is Hollywood is very worried. I mean, they're actually worried about both transactions because you've got, if Warner Brothers and Paramount merged, that's two studios, just like Fox and Disney merged. And while they talked about keeping both studios, look just years later, that's obviously been collapsed. And so Hollywood is scared of change. I think they're worried about Netflix because of what happens to theatrical, in terms of their commitment to theatrical. They're worried about Paramount because it is two studios into one. And I think Ted is trying to give assurances that they're not anti-theater. I mean, they've released a lot of movies in theaters. They've even put Stranger Things in theaters, on New Year's Eve. So I think they see theatrical as a way to create events. Whether it's 45 days, I find it hard to believe that any part of Hollywood is going to be able to stick to 45-day windows, given what's happening in box office. I mean, the thing that no one's talking about, Julie, box office is down 50%. Sorry, attendance, not box office. Attendance, meaning butts in seats, are down 50% from before the pandemic. And so the theatrical experience is just becoming less and less appealing to Americans. This is not a Netflix thing. This is just fundamental human behavior.
Yeah, me trying to convince my 16-year-old to go and see a movie in a theater, forget about it. He would much rather be on our couch, Rich. So that in theory is good for Netflix, which brings me to Netflix earnings, which are out next week. And I'm curious what you're looking for there and kind of what you think investors need to zero in on.
Look, I think investors are going to be focused really on, is Netflix doing the transaction? Meaning, are they bidding for Warner out of a position of weakness? Like, is engagement stagnating? Are they having trouble driving engagement and driving more subscriber growth and revenue without Warner? And is this sort of a defensive move? Or is Netflix crushing it, meaning they're really seeing an acceleration from a really strong slate of content in Q4? Is the advertising business starting to kick in and starting to accelerate ARPU? And are they doing this from a position of strength? And I think that's going to be really important because the stock is down on the perception that this is sort of a reaction to weakness. So if Netflix comes out on earnings and really does well, I think it's going to, really cause a surge in the stock because it will change people's perspective on how important this asset is to them, meaning, are they doing great without it? And is this just an accelerant to the story that's already doing well?
Really, really good point. I'm going to be really interested to see those numbers. I want to go back to the idea of Hollywood being scared or a lot of changes coming and them trying to grapple with it. And I want to talk to you about the deal that Ben Affleck and Matt Damon struck with Netflix. Speaking of changing and adapting Hollywood, sure. They made this new movie called The Rip, and under sort of a different kind of model, there are additional financial benefits that can be accrued to the entire cast and crew once they get to certain viewership thresholds on Netflix. It's a Netflix deal. What do you think of this deal? Is this a new paradigm, or is this just like a one-off because these guys have a lot of power and can do it?
Look, I think Netflix really wanted this film. I haven't watched it yet. I actually downloaded it because I wanted to watch it on the plane this evening. Look, Netflix, go back to the original place we started this conversation, Julie. There's a flexibility, right? And I think they're always looking at alternative models. I mean, buying Warner Brothers would obviously put them in a very different business model. On all of the movies that are already greenlit and in process, all of those have back-end payouts to talent rather than upfront guarantees. So look, The Rip, which I think is supposed to be a very good movie this weekend from Artist Equity, which is Ben and Matt's production company, it does have a different economic model. Netflix has not done that on anything else. But look, Netflix also did an IMAX-only release for Narnia, which is coming out later this year. They obviously put K-pop Demon Hunters in theaters for a few days. They did the Stranger Things stunt. Like, there is a just general, test and learn, I think would be this, in many ways, Julie. Like, does this work out better for Netflix? Do they get access to different content they couldn't otherwise get access to? I think it's showing a flexibility of management, meaning that there's no religion that is unchangeable for them if it leads to winning long term.
That makes sense. And the other story I want to ask you about in terms of a changing Hollywood is the one on Matthew McConaughey this week, where it was reported that he has trademarked all right, and other sayings and his face. And this appears to be an attempt to stave off AI using his image. And obviously that's the other big threat that Hollywood is worried about right now. Do you think
or threat and opportunity?
Yeah.
Right? I mean, movies, like, think about how long it takes to make an animated movie. I mean, 3 to 4 years. You finish a movie. Let's just say you're shooting. You shoot House of Dragon over in Europe, and it's this massive $30 million an episode type budget. And you need to make changes, and restaging it or bringing the cast back. Like, those things are incredibly expensive. Does AI have the ability to sort of enable you to do things in post-production that you never could do before? And there's lots of guild issues to work out, but I think ultimately this is going to meaning AI is going to make movie production faster and cheaper. And it's going to allow for more content, because if you take the same amount of spending and you can spread it across a wider array of pieces of content, that's going to be great, because every single company, not named Netflix, certainly needs to create a heck of a lot more content to compete in the streaming wars. And so I think AI, as much as it scares Hollywood, it's a huge opportunity over time.
We are following breaking news that has to do with the next Fed chair appointment. President Trump making some comments in the Oval Office today that might lead one to believe that Kevin Hassett might not be his pick to lead the Federal Reserve. There was a White House event, and the president said to Hassett, "I actually want to keep you where you are, if you want to know the truth." And then he said, "If I move them, these Fed guys, certainly the one we have now, they don't talk much. I would lose you. It's a serious concern to me." Now, obviously, this is not set in stone. This doesn't tell us for sure who the next pick is going to be, or even if it's not going to be Hassett. But we did see some reaction in the prediction markets. Polymarket showing Hassett's odds falling on the news. They were now at 15% from 36% earlier in the day. Who then is getting a leg up? Kevin Warsh's odds went up as a result of all of this. But again, a caution: the president changes his mind or sends conflicting signals. So it is not unusual for that to happen, and the odds could certainly change a lot more before he actually announces his decision. That said, we will, of course, be continuing to monitor it very, very closely. And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.